So good morning to everyone. Thanks for joining this webinar on consumption. So as all of you know, last week uh, during the Independence Day, government has also announced they will be revising the current GST regime. So in terms of that, and even in the past last budget, also government has provided a boost to the consumption in terms of bringing down the overall tax rates. So what these actions show is that there is a need for the governments to push the consumption demand, particularly on the urban side. So we in this webinar, basically what how we are structured is that in two parts. So in the first part, we will cover the what has happened over the last 2 3 years that led to the slowdown in consumption, and then what is the current operating environment and what's outlook. We also discuss on the Q1 results, and the second part we will discuss on the mega trends in consumption. So what are the key trends that will shape the consumption over the next 5 10 years? So that's how broadly we have structured this webinar. So just to start off the first part. So if you look at the in terms of what factors that led to the slowdown in consumption, right? So one of the major factors was that the income growth not keeping up in pace with the inflation. So post COVID, we had a strong pent up demand, and then over the course of FI 24 and FI 25, the with the waning up of the pent up demand, we saw a steady decline in the consumption growth. This is across the mass categories, and premium categories performed relatively better because those affluent people who are more inclined to buying premium products, I think their income growth was not that much impacted due to the inflation that we saw during these last 2 years. And so here in this chart, you can clearly see that the urban households in metro and the non-metro urban households. So in terms of their contribution to the overall FMCG market, if you see the split between rural and then the non-metro urban and then metro urban, it's almost similar in terms of how much they spend towards FMCG. But the the slowdown that we had over the last 2 years, that was majorly contributed by the metro households, uh, because one of the major reasons was that the steep hike in the rental expenses for the urban households. So this is the CPI basket weight. Here you can see that for the rural, I think their basket weight that they spend towards rental expenses is quite low. But on the other hand, for a household who are residing in urban areas, on a monthly basis, I think almost 20% of their income goes towards fulfilling their rental expenditure. So post COVID, we had a steep bull run in the real estate market, and that took some 2 3 years to get towards the rental cost also. So last couple of years, then we are seeing that across all the metros, there has been a almost double-digit hike in rentals. So this double-digit hike in rental expenses has impacted disproportionately on the urban households. So this is one of the factors that was highlighted by even Britannia. So this, along with the food inflation that we saw in the last 1 year, were one of the major factors that has contributed to this slowdown. And then coming to the, so this was just decoding what has happened over the last 2 years. Coming to the current picture, here you can see that last 3 quarters, we have seen rural doing a steady growth because we have seen a couple of good monsoon. Even this monsoon is expected to be normal, and so on backdrop of that, plus improvement in the rural wage growth versus the inflation, the rural demand in terms of volume has been almost stable. So there has been no issues over there. But on the other hand, if you look at urban, which was earlier in the declining pace, was also almost normalized. And last quarter, there has been some first green shoots of urban recovery. And this major recovery is because of the steep fall in the inflationary rates, both CPI and food inflation. So even you might have noticed the commentary from RBI also. So the last month, the CPI inflation notification also, we have seen that there has been it's below the RBI threshold numbers, along with good monsoon. So what this sets up is that both on urban and rural, we will be seeing a much better improved demand scenario going forward. So earlier, last 1 year, the demand was entirely dependent on rural, while urban was dragging down the entire consumption demand. So now we will have like a double engine kind of growth coming from both the urban and rural households. That's pushing up the entire consumption demand. And so far we discussed about the demand side. So what's driving the sales growth, revenue growth, and coming to the profitability picture. Even here, post COVID, we have seen cycles of inflationary. Then we have seen deflationary and then inflationary. So what this has led to is that. So the FMCG companies were not able to make changes very fast because unlike in the past when the cycle used to be much longer. So this time coming out of COVID, we had a supply chain crunch, and then we have a couple of geopolitical issues. So all this has led to the cycles in terms of how the entire commodity cycle moves has shortened. Because of that, for them to take according the price hikes was also impacted. Even if you see at present as of Q1 also, we have seen in couple of commodities there have been steep price hikes. See copra year over year they almost doubled copra prices. That's directly impacting the coconut oil and then even edible oil also. And again a couple of other commodities like coffee, cocoa, all of them are almost year over year. If you see the commodity cost increase, it is almost like 70-80%. This inflationary, steep inflationary or super inflationary kind of cycle in these commodities, what has led to is that if suppose the commodity has increased or like doubled for a year over year, FMCG companies are able to pass on this price hike to almost to the extent of 50-60%. So remaining 50% they have to take impact on their margins. And with 50% passing off in terms of price hikes, that has impacted again the demand side. So the volumes has been subdued. Even on Q1, we have seen that volume growth for most of the players has been in low single digits. So this even going forward, the expectation is that we'll be getting into a zone where the fluctuations that the volatility that we saw in terms of raw materials will be much more stable versus the last 3-4 years. And again, yeah. So here, this is a chart from the HUL presentation. Here you can see that the gap between the raw material inflation and the price hikes taken by the companies has widened over the last couple of quarters. So this shows that despite taking some price hikes, still FMCG companies haven't matched the kind of impact that they had on the raw material side. So going forward with some amount of stability retaining over the raw material inflation, this gap between the price and the raw material inflation would also be narrowed down, bringing in additional lever for the profitability growth. So on one hand, both urban and rural will be doing good, and then we'll be getting a much better top line revenue growth. On the second factor level, with the not stable or reduced volatility in the raw material side, we'll be getting a second lever of growth for the consumption companies. This will lead much better profitability growth, better than the revenue growth. So moving to the next slide. So as we spoke, you have seen a steady decline in the inflationary scenario. So this bodes well for across all the consumption sectors, not only for the staples or something like that, even for sectors like auto and the entire discretionary sectors also. And so, what are the other levers? So you're talking mostly on the inflation side. If you look at the other levers in terms of the fiscal impact that the government is bringing in terms of tax cuts in the last budget, and coupled with the latest news on GST revisions, making the slabs rates coming down, and then making it more simplification. So, and another major lever that we see is that the next pay commission revision that will come into picture next year. So, both on the monetary front and the fiscal year front, we see the entire macro picture getting more and more beneficial for the consumption sector. And so now we have mostly discussed what has happened over the years and then what's the current environment, which bodes well for the demand. Just to a couple of slides on what has happened in the last quarter. So in Q1, as you can see over here, the volume growth for most of the companies has been in low single digits, and price growth contributed to much of the part of the revenue growth across both staples and also on the discretionary side. And a couple of sectors like paints, which saw impact due to increased competitive intensity. And one of the major takeaways from the Q1 results was that we had this year the summer was quite tepid. So last year the summer was very good. So because of that, the categories which are heavily dependent on summer, for example, like room air conditioning, beverages. So the companies which are dependent on these categories, they faced a much higher slowdown in their volume growth and even sales growth, because usually these companies start building up inventory ahead of the summer season. So Q1 will be like in terms of overall, if you take annualized FY26, Q1 contribution will be like 30-40% of the entire annual revenue. So summer categories was impacted during Q1, but that's a seasonality thing, and depending on company specifics, and we have to accept that. But that was one major takeaway from the Q1 results. And this is on top line. If you go to the margins level, as we discussed, the companies were not able to pass on the entire raw material cost increase. So they have to take a hit of 30-40% of the raw material hike on their margins. So because of that, the profitability growth was very subdued last quarter. Despite rural being very solid performance, we saw margin compression across categories, across discretionary staples, across all the players, except for a couple of players on the alcoholic beverages side, because they were in a different, the base was completely different for them. That's broadly on the Q1 side. Moving towards the latest update. So this data was quite new even for us, because the UPI has become a major payment kind of tool for almost all the people. So NPCI, which administers UPI thing, so they have, for the first time, I think they have published this data in terms of where the so they've analyzed the entire UPI, how the UPI spends happen across all the households, and then based on this, for this financial year from April to July, they have disclosed the data. So if you see here, there's been a strong double-digit growth in spending towards the essentials. So if you see here, there has been a double-digit growth in utilities, groceries, high single-digit growth, and majorly, if you see, debt collection. So this shows that households are coming out of COVID, and then the increased inflationary scenario not keeping up with income growth. there has been an increase in the debt profile of the households. So that has resulted in the amount of expenses towards in paying interest cost has increased quite significantly for the households. So what basically this states is that when bulk of your income goes towards spending towards essentials and then servicing your debt, so you'll be left with a lower amount of spending power to spend on discretionary sides like upgrading your electronics or on the automotive side or spending on clothing or fashion. So this is one data which we have to watch going forward how this data comes over a cycle, because we just thought of sharing it because it was very interesting, and for the first time the NPCA also disclosed it. So this is the first part where we covered where we are in terms of consumption landscape. So I'll just hand over to Gaurav. He will take over on the second part where we will discuss mostly on the what are the key trends that we are watching for this sector. What will Gaurav?
Thank you, Senthil, for some interesting insights. Now, I will just, before getting into, I'll touch upon some mega trends that we are seeing in consumption, right? So, firstly, I think we should shift our focus to some of the trends that are shaping consumption across India and Bharat, right? What we are witnessing today is not just a cyclical bounce or short-term momentum, but these are structural shift in the way people are spending, influenced by changes in income profiles, aspirations, access, and technology also. So one of the biggest shifts we are seeing is the rise of premiumization, right? Consumers are willing to pay more for products that offer better quality, stronger brands, health benefits, or convenience, right? Then another theme that we are seeing is rise of digital native, that is D2C brands. In the last 5 years alone, over 50,000 crore plus worth of acquisitions have happened in this space. Large FMCG companies are actively buying into D2C brands to stay relevant, right? The focus has been across health and wellness, beauty, and specialty foods. Some of the examples, if you look at in the past, right? HUL acquired Minimalist for almost 2,700 crores, right? India's largest D2C beauty deal, right? Tata Consumer Products spent close to 7,000 crores on acquisitions, including acquiring Ching's Secret for 5,000 crores and Organic India for 1,900 crores. ITC also picked up stakes in companies like 24 Mantra, Sunrise Foods, and other names like Yoga Bar and Mother Sparsh, right? And Marico very recently has also built a very digital first brand ecosystem through 4 or 5 acquisitions worth 700 plus crores, right? And Dabur has also very recently entered into spices with its acquisition of Badshah Masala. Around 590 crores, 588 crores, right? So this clearly shows us how traditional giants are reshaping themselves by absorbing new age players, right? So we need to very closely watch this space. And then there's the Gen Z effect, right? The largest generation in our history. And their preferences are pushing brands to innovate. That's another mega trend we need to very closely watch. And finally, we have been talking a lot on emergence of quick commerce, which is reshaping how urban India is shopping, right? It's not just about groceries anymore. Platforms like Blinkit and Instamart are now selling everything from skincare to electronics, right? And the expectation of instant delivery is forcing even traditional brands to rethink their supply chains and go-to-market strategies, right? So the new consumption playbook is more about premiumization, digital native brands, Gen Z influence, and quick commerce. And this structural shift may define the next decade of consumption opportunities in India and Bharat, right? So we'll closely look at each one of them and then go about it, right? So yeah, next slide. Right. So here, as we look at the long-term picture of consumption in India, right, two contrasting realities are standing out, if you see, right? one is of incredible opportunity, and the other a reminder of the challenges we still face. First, let's talk about the opportunity. Over the past 20 years, India has seen multiple phases in consumption growth, right? First, we had the early 2000s where marked by broad-based economic growth. Then came a phase where government schemes and rural push drove the demand, followed by a period of moderation post 2014 as those tailwinds started to fade. And the most recent decade, right, especially post COVID, has seen what we call a K-shaped recovery, where urban premium consumption has picked up, but mass market demand has been much slower to revive. Now the challenge is India's consumption base is still narrow. Over 90% of Indians are still considered low income based on global benchmarks, right? And real rural wage growth has been almost flat for a decade now. So while the top 10-15% are spending more, the broader consumption story is still evolving very slowly, right? But here's where things gets interesting. We are seeing the emergence of a more aspirational consumer even in Bharat. And there's a gradual but visible premiumization in everyday categories that we are seeing, right? Be it biscuits, be it personal care, or be it home products, right? The affordability curve is shifting slowly, driven by obviously better access to credit, digital payments, which Senthil showed earlier, and also growing exposure to brands. We are also seeing consumption frequency increase in smaller towns, and value-led premium brands are performing better than before, right? And that's a sign that while growth may be uneven today, the structural direction remains positive. And we think the long-term consumption story is intact, but it's not going to be a straight line. We have to be very selective, bottom-up, and patient in this whole process, right? So moving on to the next one. Yeah. So continuing from our long-term view, right? What we need to understand is that India's consumption journey is deeply tied to how income distribution evolves, right? Not just income levels. And here you see, unlike China, where a large portion of the population moved up the income ladder very quickly, India still has nearly half its population living close to subsistence levels only, right? And the bottom 20% of households have actually seen a fall in real income in recent years. And this makes it hard to see broad-based volume growth in staples and mass consumption categories. So what's actually growing, right? I think two things. One, as we saw earlier, premium products that cater to the top 100 million urban and semi-urban consumers. That's growing very fast. And low penetration categories, where even small wallet share wins creates significant growth, right? For example, packaged foods. Just hold on one second. So, and low penetration categories where I was talking about, right? Like packaged foods, branded spices, premium hygiene products, or beauty and grooming, right? And that is why we think the idea of India versus Bharat is slowly evolving into India and Bharat at different stages of the same journey, right? While Bharat is still upgrading from loose to packaged, India is shifting from mass to premium and from functional to aspirational, right? And I think over the next 5 to 10 years, this dual speed consumption evolution is likely to continue. And companies that build for growth with differentiated value propositions, flexible pricing, and smart distribution channels can emerge as winners, right? And what we have to follow here is where the aspiration is flowing for consumers, right? And we are also seeing that it's increasingly growing or going beyond metros in tier 2, tier 3 cities, right? But at the same time, we are seeing that people are staying grounded in affordability and value also, right? Because that's still the largest pool of demand. So company needs to find a balance between both aspiration and value. So as we discussed earlier, right, one of the clearest structural trends in India's consumption story is premiumization, right? If you look here on the chart on the left, right, it shows how the whiskey market has shifted over the years. Back in 2015, I think almost half the sales were in the popular segment, while premium and luxury made up less than 15%. And you fast forward to 2023 and beyond, the share of premium and luxury has doubled, right? And is expected to nearly go to 2/3 of the market, or maybe higher, right? So that's clearly a trend which we can very clearly see, right? And on the right side right side chart makes it even clearer, right? The segments driving growth are not popular or entry level products. Instead, it's premium and luxury categories that are expected to deliver the fastest growth, right? Luxury growing at almost around 12% annually, and premium is growing close to 8 to 10%, right? So this is not just about liquor or alcohol. We are seeing the same story play out in categories like personal care, food and beverages, beauty, and even staples, right? Consumers increasingly in tier 2 and tier 3 towns are trading up, right? They are looking for better quality, healthier options, trusted brands, and they're willing to pay a premium for it, right? So clearly it's a trend that we have to very closely watch, right? So now let's talk about Gen Z, a generation that is reshaping India's consumption playbook, right? At almost 400 million, 377 million to be precise, Gen Z is the largest generation to ever live in India. Already they make up a quarter of the workforce, and by 2035, that share will rise to nearly half of India's workforce, right? But what makes this so important is their spending power, right? Gen Z already drives 43% of India's consumption spending, right? Nearly $860 billion plus today, right? And by 2030, there is spending will almost double to close to 1.4, 1.5 trillion. And by 2035, it's expected to touch close to 2 trillion, right? Accounting for half of India's total consumption. So Gen Z is not just about size, it's about attitude, right? They value experiences, personalization, and authenticity also, right? They are digital first brand, and they are very conscious and health aware, right? For them, the story behind the product is as important as the product itself, right? So if you want to understand the future of consumption in India, we cannot ignore Gen Z. They are not just the consumers of tomorrow, but they are already a dominant consumer force of today. Right. Next link. So quick commerce is something that we covered in detail in some of our earlier webinars, but we'll quickly touch upon here on what is the current update and what is happening here. It's one of the most disruptive forces in India's consumption story. What started as a way to deliver groceries in under 15 minutes has now expanded into a full category retail format, right? From food and personal care to electronics and even ready to eat meals, right? If you look at the chart here, it compares the leading players like Blinkit, Instamart, Zepto, right? Which are leading the pack with strong execution and delivery time of 10-15 minutes, right? Flipkart is building out its minutes offering, while Big Basket and Amazon are also trying to adapt. But their delivery times are longer and execution still weaker, right? But there are three key competitive levels in this space, right? One is execution strength. Second is private labels, right? Platforms are pushing their own brands to improve margins, and I'm sure all of us must have seen that while browsing these apps, right? And capital intensity, right? Only well-funded players can sustain the high cost of expansion and delivery. right? Another interesting thing is how quick commerce is trying to morph into retail media and advertising platform with high daily user engagement and repeat orders. These apps are becoming prime spots for many bigger FMCG names and D2C brands to advertise, right? And quick commerce is becoming a serious competitor to both e-commerce and also the modern trade. So again, a very, very interesting space to watch. So now it's clear that quick commerce is not only about speed, it's also about how the basket overall is evolving, right? If you look here at the chart on the left, right, you will see the category mix for Blinkit. In FY22, 92% of the food orders were food related, right? And just 8% were non-food. But by FY25, non-food is projected to be almost 40%, right? And that's a huge jump. And this includes personal care, household goods, stationery, and many lifestyle products also. So the model is clearly moving from being a grocery play to a broader retail play, right? And on the right side, if you see, we see another opportunity, right? Electronics is making a big way into quick commerce, right? Today, the penetration is not very high, and all of them are still below 12%. But Amazon and Flipkart are slightly higher, right? And this shows two things: that electronics is still an underpenetrated category in quick commerce, so a good runway for growth. And players like Flipkart have an edge here because they have been in this, and their existing strength in electronics and e-commerce have been there for past few years, right? So what we understand here is that quick commerce is definitely expanding into non-food and electronic categories, which have much higher margins and repeat potential, right? So quick commerce platforms are trying to become full-fledged retail ecosystems rather than just delivery apps. So we will be very closely watching this. So now let's look at how the quick commerce is performing on ground with the Q1 numbers, right? On the left, if you see operating matrix across FY25 and also Q1 of FY26, right? So the growth has been pretty reasonable. Total orders have jumped from 56 million in Q1 FY25 to almost 90 million in this Q1 of FY26, right? And monthly transacting users has also expanded, almost doubled in last 1 year, right? So this clearly shows that both repeat usage and new customer adoption are trending upwards, right? And also the number of dark stores have gone up in last quarter FY25. Q1 of FY25 was around 557. But the network is almost doubled to 1,050 plus stores in first quarter of this year, right? And again, if you see on the right side, stores at the end of the period rose to 1544, which shows how aggressively players are expanding their footprint, right? And also, most important number for quick commerce is the average order value, which now has stabilized in the 500 to 700 range, while margins still remain under pressure, right? But it's slightly improving, right? And economics can continue to improve as the density is building up, right? And the acceptability and the ability to grow orders, expand store count, and at the same time increase the frequency shows that this is a structural consumption shift that has already started to take place in India, right? So moving on, I think I'll just touch upon two more slides and then we can get into Q&A. So this slide lays out a structured framework for tracking India's consumer discretionary space. On the left, you see the macro drivers, right? Demographics, rising income, expanding e-commerce, quick commerce adoption, distribution innovations, and also competitive strategies, right? And these are going to help in the long-term growth the overall sector, right? But at the same time, inflation, customer sentiment, and pricing pressure remains key risks to monitor. If you look at the categories on the right, each has a distinct narrative. For example, grocery retail, if you pick, right, is being reshaped by channels like private labels, and there's constant battle between essentials and non-essentials, right? Store level economics and discounting or offers are very critical here, right? Then you see jewelry retail is going through formalization and premiumization, right? Gen Z and millennials are changing preferences with greater demand for branded players and moving to organized retail. But this space is also highly sensitive to gold prices and also government regulation in terms of import duties and other things. Then apparel retail, if you see, is witnessing fast fashion and value formats. New entrants like Zudio are reshaping competition, right? While global brands are trying to deepen their presence in the Indian market. The challenge here is balancing store expansion with profitability. And in QSR, which is driven by delivery growth, menu innovation, and portfolio expansion, right? So, but they are also vulnerable to food prices inflation and also offering or discount-led competition. So again, they have to work it out and fight the battle very closely, right? And paints, again, I think it's more about market share battles. We'll have to closely watch it, how it plays out. There are 2-3 players very intensely fighting out for the market share right now, right? So what it means to say that across categories, the story is a mix of structural growth trends and competitive intensity. So one need to focus on who can scale efficiently while managing risk and cost, like input cost or discounting pressures, right? So again, very closely one has to watch the entire space and how the companies are fighting it out. And moving on, I think, so this slide shows how consumption themes, right, in India and Bharat are playing out differently, and why companies are tailoring their strategies accordingly. If you look at the top, right, penetration versus incremental spend, it shows us where the real opportunity can lie. So high penetration, low spend are things like soaps, tea, coffee, oils, right? These categories are saturated, right, with limited headroom for growth. Then you have high penetration, high spend products like skincare, chocolates, energy drinks. Here the opportunity is in premiumization, right? Consumers already buy this, but are now spending more per unit. Then you have low penetration, low spend, mostly categories like ready-to-eat foods, fragrances, right? These are still emerging trends. So the challenge is going to be building adoption and finding the right price point for this category. And then you have low penetration but high spend, like categories like baby care, pet care. These are very niche but fast-growing segments, and they have significant headroom, right? As awareness and income in the urban India and Tier 2, Tier 3 rises, right? So I'll just give you some examples on how companies are trying to play this India and Bharat, right? So for example, Dabur uses low unit Ayurvedic packs, right? And in rural D2C, but focuses on premium skincare and e-commerce in cities, right? Marico uses low-cost oil SKUs and health branding for Bharat, but leverages D2C channels and digital sampling in urban India, right? Titan is adopting by offering regional jewelry designs and vernacular campaigns for Bharat. While in urban India, it's pushing premium watches and organized retail expansion, right? So the key takeaway is that brands can't apply a one-size-fits-all category. Growing in Bharat is about accessibility and affordability, while growth in urban India is about premiumization, convenience, and experience, right? Uh, so we need to see how companies fight this out. And moving on, I think I'll just quickly touch upon the GST rejig, which is recently proposed, but not yet finalized. But it could be a game changer for consumption. Currently, India has a four-tier GST system. The proposal is to simplify this into two slabs. 5% merit and 18% standard rate, right? And if this goes through, it will directly benefit sectors like durables, autos, two-wheelers, small cars, tractors, cement, staples, FMCG, retail, right? Many categories today are taxed at 28%, which can shift to lower slabs, reducing prices and boosting demand, right? This overall is aimed at simplification and boosting consumption. And if implemented, it could meaningfully improve volumes across multiple categories, while improving compliance and also reducing classification disputes, right? Like which slab, which product should fall into, right? So I think, again, very interesting. I think we'll get this clarified over the next few months, and we'll be very closely watching this space to see what the government decides, GST Council decides on this, right? So I think that's all. I'll just end up with a small closing remark, right? So we have seen how the new consumption playbook, premiumization, digital first, influence of Gen Z, right, and quick commerce are disrupting the or bringing the structural shift in the last 4-5 years, right? And how India and Bharat are evolving differently, right? And how these policy measures could accelerate demand across categories, right? Now, when we put all these pieces together, right, one sector stands out as a structural beneficiary, and that's consumption or FMCG, right? And this is a space that combines resilience and visibility with new growth levers like health and wellness, premium personal care, branded foods, digital distribution, right? And in solitaire, we have a higher than benchmark allocation to FMCG. It reflects our conviction that this sector will capture the India consumption story and compound steadily over the next few years, right? Our investment philosophy at Solitaire has always been consistent. Identify high quality businesses, buy them when they are reasonably priced, and then they stay invested for long term compounding to do its work, right? We are not here to chase short-term momentum. Instead, we focus on building portfolios that can withstand cycles and deliver wealth creation over the long run, right? The consumption theme we have discussed now is exciting to us. But obviously, they will also go through phases of volatility, and that's where conviction matters the most. By combining this patience with discipline and by owning the right businesses at the right valuations, I think and we believe investors can truly benefit from this mega shift that we are watching happening right now. So with that, I'll just like to thank every one of you for joining in.